I mean, I think the big difference, the one, if you could say, like, what is the dividing line between this, whatever you call it, DeFi bank, crypto neobank, and a normal bank is custody. So crypto alternatives do not take custody of user assets, which the reason that's important is it means nobody can come in and just take all your money. And the level of transparency is extreme compared to anything that a traditional bank would provide. You put in $1, you know exactly where that dollar is.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Mantle is pioneering blockchain for banking, a revolutionary new category at the intersection of TradFi and Web3. Follow Mantle_official to learn more. Binance is the world's #1 crypto exchange, trusted by over 290 million users. With industry-leading liquidity, security, and a wide range of digital asset products, Binance is the place to buy, sell, trade, and earn crypto. Download Binance today to get started. Today's topic is crypto neobanks. Here to discuss are Itamar Lesuisse, co-founder and CEO of Ready, formerly Argent, and Mike Silagadze, founder and CEO of EtherFi and founder of Top Hat. Welcome, Itamar and Mike.
Great to meet you for having me.
So this year has seen so many different sectors of crypto just take off. It feels like there's kind of these little mini gold rushes happening everywhere, obviously in stablecoins, in perps, in DATs, even maybe everything apps. And we're also seeing a big rush in the neobank space. So for people who don't spend their whole life on crypto Twitter, you may not know that there's many tier lists going around ranking these crypto neobanks. But before we get into all that, why don't we just make sure everyone understands even what we're talking about? So Mike, can you explain what a crypto neobank is?
Yeah, basically think of it as a self-custodial version of something like a Revolut or Nubank or Chime. So neobanks have expanded substantially over the last 15 or so years and have grown to become this massive force. It's a $170 billion space, about 100 times larger than DeFi. But they're fully custodial and suffer from a lot of the same challenges that TradFi banking suffers from. What EtherFi and I guess in Ready and other players in the space are building are end-to-end crypto-native alternative to these neobank products that allow you to save, earn, spend, borrow, all in a non-custodial way with lower fees and better rewards and much more flexibility.
And Itamar, do you want to expound a little bit on how a crypto neobank differs from any old regular non-crypto neobank, like one of the fintech options that Mike mentioned?
So I think the starting point is that probably neobank is too broad of a word. You have like 50,000 banks, I think, in the world, most of them retail. I think remittance fits into that, savings, as Mike mentioned, payment, merchant payment. There's so much into that. I think for us, the view is once you start with a different stack, let's say, so stablecoin and self-custody, you can do things that traditional neobank will struggle to do or will do in a much slower way. But I think at the end, I really love Mike's definition. We use the same, which is an on-chain alternative to a neobank, but it has to evolve into specific benefits for users, whether it's cheaper, faster, or things like more yield. Yeah.
Okay, so let's also now talk about the origins of crypto banks. Mike, I know people often talk about EtherFi as one of the originals. So why don't you explain how EtherFi got started?
Yeah, so back when we were first pitching our Series A, which was in 2023, that was actually the original pitch. Is we were going to build a vertically integrated crypto app that lets you basically replace your bank. Our starting point for that was what we became pretty well known for, which was our staking product. And that was meant from day one to be a starting point. So start by building a staking solution, build lots of users, TVL deposits, then layer on our liquid product, which is a DeFi strategy, basically investing on chain, and then launch the card product and the self-custodial, the vault, smart contract vault. And remarkably, it actually kind of worked out as planned. And we've now We tried to coin this term DeFi bank. That doesn't seem to have caught on. The market seems to have narrowed in and started calling it crypto neobank, which is a bit concerning, frankly, to me, because the word bank has very specific implications. Bank means you're taking deposits and you're regulated and so on. Even if you put neo in front of it, it's still a little bit. But the language people are using is the language, so we kind of have to go with it. I think bank alternative is maybe a better
We have similar lawyers, I see, Mike.
Yeah.
Well, actually, Mike, just one question, because you said you wanted to call it a DeFi bank, so that still would have used the word bank, but
it's one word. We said DeFi bank, all in one word.
Okay. Well, so
anyway, it doesn't matter. People are going to call it whatever people call it.
Yeah, but basically the main kind of feature is that DeFi is the plumbing that kind of powers this. It's really like a suite of features. It's not, just like I think a lot of when I tweeted about this, a lot of people were asking about the cards because everybody's so used to having a credit card and using that to pay, but there's really so many other services that can be wrapped in. Yeah.
Yeah, it's an end-to-end replacement. So, I mean, I think the big difference, the one, if you could say, what is the dividing line between this, whatever you call it, DeFi bank, crypto neobank, and a normal bank is custody. So crypto alternatives do not take custody of user assets, which the reason that's important is it means nobody can come in and just take all your money. And the level of transparency is extreme compared to anything that a traditional bank would provide. You put in $1, you know exactly where that dollar is. It's not that the bank or the entity has rehypothecated it and gone out there and started gambling on mortgage bonds. No, you put in $1, it's exactly where you placed it. So custody is that dividing line that separates the two worlds.
Just important to add, it's not we've been in self-custody for many years. It's not philosophical. Users get direct benefit. Even as simply as anyone who has banked in the US and Europe would know that you deposit anything double-digit, $1,000, you get a phone call from your banks. We fill those questionnaire every single week or month at ready. And the second you have self-custody, the regulatory surface is much smaller, which means users have a much better UX. It's really a direct benefit to users. It's not just philosophical.
Exactly. Yeah.
Yeah. Although one thing I will say is in my research, I do think that there's very few, but there are some of these quote unquote neobanks or crypto neobanks that are actually custodial. So
that's fake news.
They're outliers. Yeah, I don't think they're the more commonly used ones, but I did see at least one. So Itamar, obviously your company started as Argent and it's now rebranding as Ready. So talk a little bit about how you got started and why you're doing this rebrand.
So for us, I would say the DeFi bank or the on-chain alternative bank was a pitch from seed round already. Day zero, we saw crypto coming. We were convinced that what would happen is that self-custody was so hard that 5 big exchanges would just hold everyone's money and we would be back to the status quo of a few big banks. And we had that pitch with payment. We had there was no proof of stake on Ethereum, but we already had that vision that proof of stake would be your savings account. We had all those elements and we started with the self-custody, and in some way we kind of had built what we have now, but 7 years ago. But it was on L1. And so our product was free. There was no seed phrase. There was no gas. There was crazy growth. People would use, when Compound launched, it was the first DeFi protocol, people would start using it for saving. So we kind of thought we had it. And then, of course, DeFi summer came up. The gas fees exploded. So creating a wallet was impossible. And so our product evolved into a product for whales. We had more than $1 billion in assets. We had a single user depositing $500 million into the app. That's not a mass market consumer neobank product. It became super safe cold storage, basically. And so we really evolved into really a technical, complex wallet. And even though as we evolve on the chain level, but move further and further from the neobank. Then we came to that realization that wallets will not become those products. They are too complex. They are very less opinionated. They are generalist doorway to an ecosystem. And so we really wanted to make a strong mark around this, a very different product, different focus, splitting those products, wallet versus crypto neobank, and that's where we did the rebrand to really mark that.
Okay, so let's talk about the credit card aspect because, like I said, that is the thing people seem to be focused on. I don't even know, is it difficult for something that is being powered by DeFi on the back end, like that kind of operation? Is that hard to get, a connection to Visa or MasterCard or whatever to establish the credit card portion of the services?
It's hard to do it right and to make it good. There are many, many quote unquote crypto cards out there. Almost all of them are terrible. I mean, I can get into why, but probably, frankly, if you've tried one, you know what I'm talking about. So, tons of fees, complexity, no actual crypto in that you have to like sell your crypto for fiat to load the card, stuff like that. Most of them are really terrible. So it is hard because you have to, put in a bunch of sort of plumbing and make sure that you're on side in terms of regulatory requirements. And then it is hard to actually make it good, as in our case, I mean, we started the card product, the transactions being on layer 2 from day one. So that is a must have if you want to have a card that doesn't charge you, $1 or $2 in gas every time you do a transaction. But there's lots of abuses, like there's lots of programs that use commercial bins, meaning they use commercial card programs to issue to retail, which is super illegal. You shouldn't do that. And those programs, of course, eventually get shut down. There's programs that issue cards in regions they're not allowed to issue cards in. So you have to get a legal opinion in every single country, sometimes every state, but where you're able to issue, how you can market, and so on and so forth. So it's hard to make it good and to do it right. That's the short answer.
Well, but
I would add it was impossible before.
Correct. Yeah.
You couldn't have done, I think, what EtherFi already is doing 3-4 years ago, probably.
Yeah.
Even 2 years ago was borderline, and then it became possible. So I think that's why you see there's a reason why everything is happening now.
And what was it that changed that made it like a lot easier all of a sudden?
There is one, the appetite and the regulatory clarity. So I think that's probably the biggest change. So you wouldn't have been able to issue a card linked to a non-custodial wallet. It was really something only centralized exchange could do. It was a fiat card. So the point of Mike is a lot of card. There's a real difference because once you have a very pure model where it is resettled and stable, I'm pretty sure is the case for EtherFi, you can really lower the cost and have a very efficient model. Cards have always existed, but you would have paid between 3 and 6% in fees basically for every transaction. Partly because the model was less efficient, partly because people would just add a lot of fees. So regulatory appetite, we needed L2s, low fees. For us, account abstraction play a very big role to have what I think is the purest self-custodial model. It's not like some hosted wallet. And so all those places came together at the right time. And you see Visa and MasterCard being extremely open and much more bullish about crypto now than they were 3-4 years ago.
And when you mention the regulatory clarity, is that the Genius Act, like the Stablecoin Act here in the US, or something else?
I don't think the Genius Act really impacted that. I think it's more before crypto was taboo and dodgy and why people wouldn't take the risk. The reality is I don't think there was clearly a defining policy. It's acceptable, it's mainstream, everyone knows crypto, they can afford it. So they can afford to do it without having a reputational risk.
Mm-hmm. Yeah, that's exactly right.
And then when you are dealing with the network, like Visa or MasterCard or whoever, what kinds of questions are they asking you as entrepreneurs? Like, do you feel like there's a higher bar that you have to meet because of, what other services are attached to, the fact that you're not an actual bank, that you don't have custody of the assets? Like, what kind of questions are you getting? Or do they not care?
This is a technical detail, but it's an important one. Pretty much every crypto card program out there, almost every single one, works with a sponsor. So there's another company that has the Visa or MasterCard principal membership, which means they can actually issue the cards. And they get sort of a BIN, meaning like a card number block, and they assign that to a partner. So they're sort of lending out their license with Visa. So these companies, we use a number of them. The main one that we use is a company called Rain, which has been fantastic. That make this much more feasible, and including things like stablecoin settlement. So we don't need to wire money to a bank account. We can just settle directly in USDC. So all these components are, the hard work has been done by companies like Rain to educate Visa and get everything set up so that they understand these crypto card programs and see it as a growth market. It's now at a size where Visa and MasterCard actually care about it. Whereas previously, even though it was around, it was so small that it wasn't even worth the hassle of doing it. Whereas now, I mean, with EtherFi, we're doing like 1.5 million a day, which is actually meaningful for a crypto card program. It needs to be about 100 times that to really be meaningful at a global scale. But for a crypto card program, that's meaningful enough that we're talking to Visa now. They actually care. They're seeing this as a growth area, and they're starting to invest in it and nurturing the growth.
Interesting. And so I also imagine the regulatory aspect is a little bit of a nightmare, because another thing people were asking is like, oh, is this card available in this country or that country? Or, and even like I noticed for the US, like it's asking you which state you're in and stuff like that. So just talk about, because like that in and of itself just sounds like that could be, I don't know, like a few hundred, if not even 1,000 different types of regulators that you might have. Yeah. So explain that part.
Well, so just to put it in perspective, we have 4 full-time compliance people. So, that doesn't sound like a lot of, for a crypto exchange, for example, but, for a DeFi, product, that's the overhead here. We have, legal counsel, we have compliance, we have to get legal opinions. So we have to if we want to issue cards on a reverse solicitation basis in, Spain, we have to go to a Spanish law firm, get them to issue a legal opinion. They give us a report that says, here's exactly how you can, issue cards to people. Here's exactly what you can and can't do from a marketing standpoint. It's an absolute nightmare, but even as much of a nightmare as it is, it's probably 1/10 of as much of a nightmare than if we were a fully custodial regulated institution.
That's the critical part. People don't realize, I think, how shielded we are from that complexity. You work with Rain, we work with Kulipa. They are the regulated entity. I think both of us could decide to be regulated, to integrate vertically, but I think there's something actually very strong in splitting that for many reasons, which allows us, I think, to stay a tech company versus financial services. Mm-hmm. And so I think being able to, the separation of concern makes life much easier. You mentioned different markets. Yes, it's more work per market, but experience has been, we started, I think, from opposite markets actually. But I think our experience was that you can really replicate that. But in some markets, we might work with Visa, in some with MasterCard. It's been, I think it's, as you say, some people took shortcuts. I love your example of the corporate cards. I think when you see a card that is in every market with no KYC up to $1 million, there's probably something very, very fishy, and a lot of these cards will disappear and will be shut down.
Huh. Okay. Yeah. Yeah, that does make sense, because I did have some other questions, which I'll ask in a little bit about that aspect. But I did want to and I remember actually it was a comment that I was going to make, which is when you said that you had people on your staff to do this role, and they would literally have to go in and meet the regulator. I thought to myself, oh, okay, so I guess AI isn't removing all the lawyer jobs just yet.
No, unfortunately not. Yeah, still paying a couple $1,000s an hour for a lot of this stuff.
So I did want to ask about the fact. So I don't know how it works in other countries, and maybe it's the same, but at least in the US, when you apply for a credit card, and it will check your credit score and things like that. So it seems like that's also happening for this card. So like basically, people will have their on-chain identity, but then it'll be linked to KYC, and then on top of that, it will be linked to their credit score. So is that how to think about it?
So in our case, no, we don't check credit score because it's fully collateralized. So we don't issue uncollateralized loans like many card programs do. We do plan to eventually do that. Probably in 2026 we will start, but But for now, it's fully collateralized. So you have all your stuff in the EtherFi vault, the smart contract wallet, and then we give you loans if you want to borrow against those assets, but it's fully collateralized. So we don't need to check your credit because your loan is backed by
Right.
assets.
So it's more like a debit card.
It is issued as a credit card. There's actually an important distinction there. When you issue a debit card, it won't work for a bunch of things. So it is issued as a credit card, but it is fully collateralized credit.
Okay.
Very similar model to us. We have debit in some market, will be credit in others. In Europe, debit works better than credit. In the US, credit works better than debit. But at the end, users use on-chain loans, fully collateralized.
Okay. So basically, the credit limit will just be determined by how much Ether they have in their vault. Oh,
Or any assets. I mean, one of the
right.
advantages that, and I'm not sure if Ready has the same thing, but it's kind of an obvious, next step. In our case, a user can have DeFi strategies. So you can have assets that are in a strategy vault that's earning, depending on the day, these days, I think around 10% yield on your stables. And you can use that as your payment currency. So it's almost a little bit like, imagine you have an S&P 500, index fund, and you're using that to spend day to day, or you're using that as collateral to borrow against on your credit card. I think that's one of the incredible things about crypto and DeFi, and why this thing is interesting, is that the composability allows you to create products that would be impossible to create in TradFi.
Right.
So many of our users, just to finish the loop, many of our users will have a bunch of assets that are earning, let's say, 10%, and then they'll be borrowing in Aave rates, which are much lower than 10%. So you're getting this arbitrage, this interest rate arbitrage, basically.
Okay, so it's so basically the traditional lines between your investment account and your savings account and your checking account, they just get all blended into one thing. So you don't even have this separation of you're keeping money just to transact in one place.
Yeah.
Got it. Okay.
It's exactly right. And that's the power of this model, and why I think it's going to take over the world, because there's this ridiculous kind of artificial distinction that currently exists, exactly as you say, where your insurance policy is over here and your investing is over there and your checking account is here and your mortgage is, and then none of them talk to each other. In this case, imagine you have a wallet that has your dollars, your stocks, your art collection, your mortgage, the house, the NFT that represents your house, and the entity, the protocol, sees the entire financial picture of you as a person and can issue you credit and products, and all of it just works seamlessly together. Something that would be completely impossible in TradFi. And even if you were to try to create it, it would be only available to people that are, ultra high net worth. So I think that's the power of this whole crypto neobank model.
I love it. Itamar, did you want to add on that, on how it basically kind of upends the entire way that most people think about how they organize their finances.
I think I really love my point, because we see a lot of the same thing, and in crypto you realize that we are trying in the UX sometimes to recreate those patterns, but the reality is there's no such thing as checking, savings, etc. And we really see also this element of products that exist in TradFi, but they are very exclusive products. The collateralized loan is the most, it's always something that's used by Elon Musk, Jeff Bezos, but the reality is we use it so much in crypto, it's so common. For us, we really see, when we started to do that with Bitcoin, which was not something we're very active, and then we became much more active in Bitcoin, that's where we realized actually there was real demand, because it's less easy to do typically on the Bitcoin world. But also things like even integrating hedge fund investment, basically what we would call exotic investment, are much more achievable in crypto. Everything is tokenized. Whether you invest in Aave or some hedge fund, is actually the same thing. So we see, at least in some markets, more of a demand for those, let's say, private banking products. Everyone has access now to private banking products once they're on chain.
Okay, so in a moment, we're going to talk a little bit more about the types of offerings that we're seeing here in these crypto neobanks. But first, we're going to take a quick word from the sponsors to make this show possible. Mantle leads the establishment of blockchain for banking as the next frontier. UR is the access layer that transforms Mantle Network into a purpose-built vertical platform, the blockchain for banking, that enables financial services on-chain. UR unifies and vertically aligns Mantle's focus on payments, trading, and assets. MI4, METH protocol, functions FBTC, supported by developer grants, ecosystem incentives, and the industry-leading distribution platform through the UR app, Reward Station, and Bybit launch pool. All economic activity within UR will be captured by Mantle Network to further drive value to token holders and establish its significance in blockchain for banking. Follow Mantle_official to learn more. Binance is the world's #1 crypto exchange, trusted by over 290 million users globally. With world-class liquidity, security, and a wide portfolio of digital asset products, Binance makes crypto easy for everyone. Whether you're new to crypto or a professional, Binance offers a simple user experience. Learn with Binance Academy, browse hundreds of tokens, and track your portfolio on an easy-to-use dashboard. For experienced users, Binance Pro provides industry-leading services and bespoke trading products. With some of the lowest fees and deepest liquidity in the market, it's no wonder over 290 million users choose Binance for everything crypto. Buy, sell, trade, earn, live crypto. Download Binance today and begin your journey into the future of finance. Disclaimer: Binance is not available in certain countries, including the US. Check its terms for more information. Binance.com/en/terms. Back to my conversation with Itamar and Mike. So let's talk about the back end. Now, we kind of talked about the front end, and I mean, we did talk about the back end sort of in an abstract way, but just describe, so if it is really that, users can kind of use any different types of DeFi offerings in the back or whatever, like, are they limited to certain ones? Like, are only certain ones allowed to work with the card on the front end, or, how does that all work? And either one of you can go.
Yeah, so we have specific vaults. We try to be the easy button for DeFi. In terms of the wallet and smart contract wallet structure, we want to make sure the users don't get wrecked. Which means you can't just sign a random transaction that will drain your wallet. We have a lot of protections and kind of bubble wrap around it. Eventually, like we want this to be mostly normies using this product, and so we tried to make it simple for people. So we have a product for ETH, a product for BTC, a product for USD. One click, you deposit it, and then magically, not in a non-custodial way, deploys it into DeFi, and you don't need to really think about it.
It's similar. It's not a technical decision. It's really a pure product segment. I mean, you will have as many neobank as segment of users, and in our case, extremely opinionated with 3 assets. It's ETH, BTC, and USD, or local currency. It could be euro. We're working on that, and then we have a matrix of like 3 risk rating. And so extremely curated, extremely opinionated. And that's really the product relevant to users. If you take a loan, you can't go for like a 90% usage ratio of your loan, where you will be right. So it has to become a product that right now, I think crypto cards, and even ready to be honest, where you stick a crypto card. And we have been evolving, and by the end of the year, we'll be there where it will feel really like a traditional neobank product on TradeFi, just with security guarantee around self-custodiality. No one can freeze your funds, etc. So that's really a product decision for our segment to be extremely opinionated.
So for some of these rewards in the background, like I noticed EtherFi's current liquid rewards are 12%. So explain like where that yield is coming from.
Yeah, I mean, it's like any DeFi. Those vaults, which have a third-party strategy manager, tend to be very conservative. So there's no directional risk. Usually, the risk is just DeFi protocols, but the protocols we use are things like Aave. So I think, for example, the USD vault, there's a bunch of it that's deployed into Ripple, so RLUSD on Aave, which is a pretty boring strategy, but Ripple, I believe, is paying incentives to be able to provide those higher yields. So the short answer is it's mostly lending and various token incentives that generate the yield on the vault.
And
And
in our case, we go broader, just to add on that, because so lending is something everyone, we're also looking, whether it's on L1 or we bring it from any chain you need. But for example, if you look at Bitcoin, we specifically do staking on Starknet because now you can stake Bitcoin. So that's not incentive. That's how to secure the network, which is something we couldn't do months ago. So now we have native yield, sustainable yield on Bitcoin. But we're also working on things like funds, like fully managed hedge funds, not by us, but like big names that manage crypto funds, which means, you have different exposure. They tend to be custodial. They get your funds. They maximize benefits. So that's more like investing in a hedge fund. So very opinionated, but still a range of risk reward appetite for users.
And so it sounds like some of this is basically just farming on the back end. So traditionally the reason that networks would offer those incentives is to attract people who might stay after the incentive program. But I guess if they're just offering it to these cards and or the neobanks, and then the neobanks are just moving the users. I mean, not that it's necessarily. I'm just more thinking about the networks that are offering this. I don't understand necessarily what's in it for them.
They're offering these yields to DeFi because they're trying to integrate their assets in DeFi. They're trying to become a stable coin that's, with Ripple, I imagine they're trying to become a stable coin that's broadly used in Aave and other, DeFi protocols. And then we participate in that. So I wouldn't even say our job, what the strategy manager's job is to just source the best of available yields in DeFi, which might be the basis trade, which is, broadly available, might be these token incentives, and generally, historically, and I think for foreseeable future, the rewards yields in DeFi are going to be higher than in TradFi because you're stacking the T-bill yields, which are underlying, with additional rewards that come, directly or indirectly from the speculative nature, of the crypto market.
I would say our job is just to bring the best product to users. If that means going on other chains and to while being very transparent on the risk. And so that means, so we do things like, yes, if there is a token reward, it's automatically repaying the loan, etc. So making it super simple for the end users and just them having certain confidence they will get maybe not the most degen extreme opportunity, but the best risk adjusted opportunity out there. And we also work with Vault Curator, working on with Stakehouse, etc. So a very similar approach. I do think the chains doing that still get benefit, or the stable doing those incentives still get the benefit. They want liquidity in the system. We are contributing to liquidity in the system.
Right. That makes sense. Well, I did also want to ask, so earlier when we talked about how you could kind of compress what in TradFi would be multiple different accounts into one place, and then, just have a credit card that would be attached to all of it. Talk a little bit about how the security works for that, because obviously in crypto, we know there's been so many hacks and people losing funds or their private keys or their seed phrase or whatever. So explain, if someone were to, put what in TradFi would be divided across multiple accounts, how does it work for them to keep all of that secure, even if it's all in one place?
Yeah, I mean, I think smart contract security has come a long way since the DAO hack, where, a fairly trivial error allowed somebody to, steal millions. So there's many layers of protections that come into place. So obviously there's smart contract audits. That's table stakes at this point. You do multiple audits. We also do formal verification, which is a process where you kind of make a mathematical model of the smart contracts and make sure certain, invariants can't be violated no matter what you put into it. We have active monitoring, which is where there's a system that looks at anything being deployed on chain that might interact or do something to your smart contracts and can proactively pause the contracts if something looks wrong. Operating on an L2 provides some protection because you need to get the tokens off the L2 to fully sort of escape with them. So, it's not perfect. I don't know, what point you can call it perfect, but we are, I would say, rapidly approaching a level of security and robustness that's close to what you would actually find in TradFi. TradFi institutions blow up all the time, right? I mean, every year that this happens, they usually get bailed out, I guess. But the fact is, these blowups happen, and I mean, I think DeFi has shown itself to be, starting to get to close to as robust as anything you can find in TradFi.
And I would say it's in some way easier to safeguard the current product we're doing, both for EtherFi and us, very opinionated product. Than we've been in the business of securing billions in wallet. We have more TVL than many L2s. But when it's a generic wallet that can sign anything, farming something, claiming an airdrop, it's much harder. We work on smart account for security for years. Here, it's a very opinionated product. We are not offering like the latest new protocol that has been live for 2 months with 600% APR. It's well established. You mentioned Aave, there's Morpho, Lido, very, very well established a protocol that went through all those years of battle testing and security measure, plus the wallet itself. In our case, we work with smart accounts. There's more than a signer. So even if all the cryptographic material in your app was compromised, you will still be protected. We are working on adding things like trusted address. You can add times delay. There's a lot of mechanisms. Recovery for us have delays. As I say, it's exactly the same philosophy that what we did on L1 with wallets as big as $500 million in wallets. So on that sense, we are pretty comfortable. The biggest risk, honestly, is more market crash. What you saw a few days ago. Again, if you are focused on USDC, ETH, and BTC, you were probably fine. But if you start to do other type of investment, having a token that can drop 60% is probably the biggest risk here.
Yeah, and actually, when I asked my question, it was more around the wallet security. But it sounds like right now you have it set up in such a way where it's like somebody can't lose their private keys.
Yes, in our case, there's no private key exposed, but you can still have censorship resistance. With our model, you could decide you have so much money, you could still have, for example, a hardware wallet, set that up as an extra signer because really you want to do the extra effort, and then you could craft a transaction that would you get escape hatch, basically. The idea is really getting escape hatch, and that's really something Icon Abstraction allows. It's quite standardized now, and they are a very good model there. As I say, we have never lost funds from a user.
Yeah, any sophisticated system these days, it sounds like on both our sides, it's not just like an EOA. It's not just a wallet. In other words, it's not like a one, seed phrase or private key that controls the whole thing. It's a smart contract. So, which means there's a bunch of code there that protects you with. Again, in our case, same thing. You can have a hardware wallet that you delegate to sign on behalf of it. You can have ways of recovering in case you lose your phone or your hardware wallet. So in all these cases, we're way, we're well past. Again, modern sophisticated systems are way past the point of just like, okay, here's a wallet. Just please don't lose this phrase or else it's all gone.
And how do chargebacks work in this world?
Same thing. As in the normal world, if someone disputes a transaction, we escalate it to Visa and goes through the same process.
Oh, okay. I see. So
they get refunded in stable. That's it. At the end, stable is money. When you were in Neobank in the UK, you didn't have fiat money. You had EMI money. It's an e-money, a new type of money because it has a different regulatory aspect, and stable is the same. It's just money.
Yeah, it's basically like it's a building where there's a revolving door in the middle. And on one side of the revolving door is like DeFi. And then on the other side of the revolving door is like the normal credit card world. So, but it's all housed in the same building.
Yeah, that's a really great analogy. It's like, where do you place the door? If you look at, for example, a centralized exchange, like at Coinbase, for example, they have that access to DeFi, but they place the door well within, like, it's almost like there's two countries. There's DeFi land and TradFi land. They place the door well within like TradFi land, whereas like for us and Ready, we place the door right on the border, where like you don't get all of the encumbrances that you normally get if it was like a largely TradFi system, but you get all the benefits that you get from DeFi, and I think that fundamentally is a better model. I mean, EtherFi, if we were a TradFi institution with $12 billion in deposits, we would have probably 600 employees. EtherFi currently has 32 employees. And so there's a more than an order of magnitude cost difference in terms of operating this institution that eventually will provide all the same services, in fact, better. And that those costs savings go back to users directly or indirectly. It means we don't need to screw our users in all kinds of hidden fees. We don't need to screw them with 5% FX fee charges and deposit fees and chargebacks and whatever, all this stuff, because we don't have as much of a cost basis. That's why this crypto neobank model really can, and I believe will, replace the TradFi model. It's just much more efficient and better for the customer.
At the end, I think that's interesting. That's our philosophy. We talked about it at DevConnect. Is really at ETC is like the technology is there to make a neobank-like product 90% more efficient. I think the stable rails is the big part of it, but you can even put in that AI around customer support. Obviously, we don't need branches anymore, but that's been done for a while. And so the challenge, obviously, is that there's no user that will come because you have 80% smaller capex or opex. These need to translate into benefit, whether it's, of course, and the easiest one is, of course, lower fees. But at the end, I think the challenge is for the crypto neobank world is figuring out segments when we can really offer 10x values. And the obvious one has been today, I think for everyone, probably crypto holder, that the second they would cash out to their bank would get their account frozen and live a month of nightmare. And that's been really low-hanging fruit for many.
Yeah, that makes so much sense. I wonder if there's any bank executives listening to this that are like, oh, damn, we shouldn't have done that. Well, I did also want to ask, so talk a little bit about your business model, because, this is a world that's quite competitive. And I saw like a breakdown of some of the economics behind the scenes, and it definitely looks like a low margin, high scale kind of business. So at least the discussion of EtherFi that I saw. So Mike, talk about the numbers, how you're making it work.
I mean, we're very profitable, even with because I think we do have some a good amount of scale with the amount of assets. So right now our run rate is around $85 million a year, which is for 32 employees. I mean, that's a great business. And from a user standpoint, they're getting way lower fees. They're getting 3% cash back. They're getting these great yields on their products. So it really is a win-win. The reason that our model works more so than any standalone card program, I think any standalone card program is a complete dead end. You can't make money that way because you make a little bit of money on the interchange, which over time gets compressed, meaning like every swipe the merchant pays like 2 to 3%, and you get a slice of that. So you make a little bit of money on that, but the cost overhead kind of absorbs most of that. But where most of the revenue comes in is there's a spread if people are borrowing, within the product, make a little bit of money there. If they're in the DeFi strategy vaults, we make some money there. If they're staking with us, we make a bit of money there. So there's a lot of like layers that you need to add such that the average revenue per user ends up being, depending on the cohort of users, $500 to $1,500 a year, which in revenue to EtherFi, which is great. If you look at a company like Chime, for example, their ARPU is around $200 per year. If you look at a new bank, it's a fraction of that. So you have a model where we're able to generate substantially more revenue from the customer while charging them a lot less fees and providing a better service. So, I mean, it really is just a better economic model kind of across the board.
Itamar?
I totally agree. I mean, card is not how you make your money. I mean, you say it will be compressed. If you look at globally, Europe, for example, is compressed that through regulation. You don't make money on card. For me, it's a go-to-market marketing angle. It's a product people want, but you offer it almost for free. And then it's everything. I mean, performance fee basically is the most obvious. That's why we don't present ourselves as a Venmo or a Cash App. Cash App became more than a payment app, but we then started as a payment app. It's really payment and investment because it's investment and you can make, buy Bitcoin, buy ETH, get yield. That's where you can make real money at scale. But as Mike mentioned, the cost basis is also much smaller. So you can create quite quickly pretty good businesses. You have other model. You have a subscription model, of course, on cards. I believe I'm not EtherFi. You have the same. We have a premium model.
We don't, but
Yeah.
yeah, that's
Okay.
that's a
It's very
common
common.
model.
That's how Revolut also. I think where really we will all start to make a lot of money is when we will move FX on chain. The volume will be so much bigger there. Move FX on chain, take some spread there. I think if you take beyond the core currency where TradeFi is extremely good, there is a future where we can offer significantly better FX to end users while still making extremely good money there.
Oh, wow.
That will take a few more years.
And when you say on-chain, like, I mean, what would that take? Just like stable coins in every fiat currency, or?
Yes.
Okay.
Yes,
Okay.
especially the long tail. That's where you will start. Right now, for most card model, all of crypto is USD. Basically, you settle in USD, and then Visa, Mastercard will make the FX at a good rate for the large currencies, and then up to us. We don't take any fees. We want the lowest possible FX. But once you move all of that, and you can have, Buenos Aires right now, it's not good FX. Once we can move that on chain and have a much more efficient FX market, then there is an order of magnitude more money to be made.
Yeah. It might have
the average. I got the number this morning. The average in Africa, the average FX, the person who had the call with me an hour ago will smile because I'm reusing that, but the average FX on the African market is 7.5%, the average spread.
Oh, wow.
One of the market, I think Ghana was at 20%. That tells you
20% to another African currency, or?
Always tend to be dollar, USDC or USDT. So I'm talking for crypto, USDC, USDT to their local currency. So the average for the entire continent 7.5. That's what we're talking about. So offer users, 0.5. It's a 10x improvement already, and you can still make another nice margin there. Yeah,
that's so interesting. It's kind of shocking how far behind we are in that, because I think currently the stat that I saw the other day, I'm blanking on what the source was, but it said that 99.8% of all stablecoins are still denominated in US dollars. So, okay.
But we start to see a change. Yeah, I think we started seeing really with Europe because the US did a really good job to devalue the dollar. And it's the first time we see that where people are like, I lost 20-30%. I lost all my yield in FX, the dollar went. And so people want at some point to cash out in their local currency and spend that. So
yeah, that I as an American, I feel it. Okay, I did also want to ask. Sorry, I remember. So, Itamar, because you briefly mentioned this, but you guys are kind of leaning into this BTC-Fi, and you have this program with Starknet. So is this kind of what we were talking about before, where they are offering this promotion, and it's sort of like a farming thing, or like just talk a little bit about why that's a big part of Ready?
So at the end, as I said, we want the best yield for our users, or the best safe yield. Bitcoin is where it was the hardest to find something, to be honest. On USDC, on ETH, you don't have on L1. There are many options everywhere. And so BTC-Fi is really two things. One, there is organic native yield that is not incentivized. That's the ability to stake. So Starknet is, I believe, the only L2 that is as a multi-sequencer. So it's decentralized, but it's still permission. So it's Starknet running the sequencer. It's phase one. And then it will be permissionless, where anyone can run sequencer. But that means you have a decentralized network running there, and you have a consensus. All that is live, and you have a proof of stake model to secure it. You can stake Stark, or you can stake Bitcoin. That means you have native yield the same way that we have native yield with ETH when we stake it. That's one thing. In parallel, BTC-Fi, where there are incentives, it's on making Starknet the best place to borrow against Bitcoin. So if you want to borrow USDC against Bitcoin, that's where you have incentives, where the end goal for us is basically having a loan that repays itself through that. And that's, yes, it's artificial, it's incentives. Obviously, as that grows, we'll end up to have a place with a lot of liquidity to borrow against Bitcoin. Not as good rate, but still probably some of the best rates in the market.
Okay. And Mike, so EtherFi also has Bitcoin, but it's with eBTC, which I'm assuming is
Yeah.
EtherFi BTC. Okay.
Yeah, and we use Babylon and Lombard for yield generation, and then the DeFi strategy vault for Bitcoin, sources yield wherever is to be found.
And out of curiosity, I don't know if this is a public figure, but what percent of people are, or yeah, out of what's being staked on your platform, like what percentage is Bitcoin versus Ether?
Oh, it's almost all ETH. Yeah, I mean we're EtherFi, so
Right.
that's quite sticky.
Okay.
Our USD, there's quite a few USD deposits that people use. They're both spending and borrowing assets, and that's growing. But in terms of assets held on the platform, the vast majority of it is ETH.
That makes sense. I did notice that also the DAO votes on some of the parameters. So I was wondering how that works with running a business. Like, what does the DAO decide and what does management decide?
Well, I mean, everything, the way our governance system works is the DAO elects a manager, which in our case is the Labs company. And the Labs company gets a fair bit of latitude in terms of just day-to-day operations. It's not, the sort of nightmarish DAO governance that a lot of protocols fall into, where every single decision ends up having to go to a vote. But big decisions that certainly involve anything, using the DAO treasury, like using tokens for incentives or big partnerships, those do go up for a vote.
Okay. So before we wrap, are there any particular tips that you would that you think consumers should look for when they're considering which neobanks to use?
Sure. Yeah. I mean, there's lots of scams out there. Look, there's a few good products. I haven't looked into them with enough depth to be able to I usually am totally fine recommending competing products just for people to try it out. But there's a lot of stuff like, again, like programs that if a card program doesn't do KYC, or you send a picture of your shoe and that proves and as your identity, there's probably an issue there. You probably shouldn't use that product. If a program offers you X% cash back, but really it's some freaking points program, you should probably look at maybe what's going on there. So just read the fine print. There's a handful of reputable products out there that are actually pretty good, and users should choose the one that makes most sense for them.
I think the most important part is which one to avoid rather than which one to recommend. There are a lot that are too good to be true. And yes, the no KYC is something, fine, use it, but don't put all your funds there because at some point it will shut down. I think at the end, the entire point, I mean, I think Mike, you mentioned that we had an exchange around, are we competing on that? At the end, there is 99.9% of the users are not using and are not on chain. And so this is the pool of users, and people should look for products that fit what they like, what they need. The entire point of what we are doing is you can create really hyper customized experiences. It's so much easier to build, so much faster. And so you can create something that is much better for your segment. If you are a Bitcoiner, you want a card that would generally say, I think we have a really good angle, you will get great yield, it would work really well. But if you only have ETH and you want yield, we have it, but there are probably 10 others who have it too. So look at who has, some people are better for family cards, some better, we're working on inheritance. If you care about that, you'll come to us. So look for what you need and find the best product for that.
Okay, so last question. When I was researching this, I just thought this seems like such a no-brainer for somebody who is interested in crypto and wants to optimize their financial life, like definitely for young people, like no question, like just no question. It reminds me of how I'll talk to my parents and they're kind of like, we still prefer going to like a physical bank, right? That's because they're used to that. And for me, I actually started online banking all the way back in the late 90s, like maybe 98, 99-ish era, which at the time I remember I had this roommate who worked in finance and she just like try to make me feel so like I was so stupid for doing online banking. And yeah, like everybody does it nowadays. But anyway, point is just that when I was thinking about this, I happened to see, so somebody tweeted this like a few months ago. My bank in Dubai called today just to check if I was okay because I haven't used any of my cards in 3 months. I didn't know what to say. So I just said, yeah, but honestly, it's just because I've been using. And so this is another one of the neobank cards that like, because I tweeted asking for, what's your favorite neobank or whatever. And this was one that came up multiple times called Cast Card. I have not looked into this, so this is not an endorsement, but this is what this person just said. They said, because I've been using Cast Card nonstop since I got it. and I kind of thought to myself, yeah, I could see once somebody gets into this world, like, yeah, if you can make 10% or 12% off of the money that you have in there in the background, plus, you get all the normal benefits that you have of like what the modern world is used to with this credit card thing that's been around for decades. Like why wouldn't you do that? And even just the ease of use that we talked about, where like all your accounts are in one place, and that's not, or sorry, all your accounts, but all the ways that you use your money are in one account, if that's how to express it. I don't even know how to express it. So anyway, so I'm just kind of curious for your thoughts on like how quickly you think this will change banking, or what it will do to the banking sector.
I mean, look, in 2007, at that time, Google existed, the internet was pretty big. Facebook, I think, had already launched. Traditional advertising was still substantially larger than online advertising. And in fact, it was growing. I mean, if you look at the graph, it was like up and to the right. And then over a period of really a couple of years, it just fell off a cliff, and digital advertising just completely took over. Now, I mean, digital advertising is advertising, basically. I think it's a similar kind of thing where things change slow until they don't, and then they move really fast. So I think we're in the tail part of the exponential growth curve, but at some point you hit that kind of inflection point, and it just takes off, and then it goes from a fringe thing to basically the only model. And there's going to be hundreds, probably thousands of companies that that play in this space.
I think people don't realize how early we are in that transition. I mean, if I look at Reddit 2 weeks ago, we didn't have bank accounts. So only crypto users could deposit money. Now we offer bank account, you send dollar, you have stable behind the scene. This is literally, I think this week, I don't know if we have even announced yet. So we are still in that phase where all those building blocks are being built, are being launched. If I look at our roadmap, I feel in 3 to 6 months, the core things, it will feel like a Web2 TradeFi product, and then hypergrowth can start. But there's still some blocker. I'm sure Mike, you think also about privacy. We have some initiatives there. So there will still be some use case where we'll see some blockers. We like some long tail of stablecoin, etc. So, but I feel it's moving so fast. I struggle to see what will be missing, let's say, a year from now. And then it will be a go-to-market game and a race between how fast crypto products take over traditional finance and how fast traditional finance moves towards crypto. The likes of Revolut are very crypto savvy. They move very fast. Neobank is looking at it, and the like of Klarna are looking at it.
Okay.
The neobanks are not dinosaurs. They're also working on that.
Right.
All right. A last quick question, because I realized I had meant to ask this when I asked about security, is just, so in the US, like when you have a bank account, there's like this FDIC insurance. So like, does that concept apply here at all, or no?
No, but
No.
I mean, I think equivalent insurance policies are going to come into play.
Oh, okay. Yeah, because obviously
Over
since
time.
it's self-custodial, yeah, it doesn't make sense that, okay. All right, you guys. Well, it's been such a pleasure talking to you both. Thank you so much for coming on Unchained.
Thanks, Laura. Mike,
Great
always great to be with you here.
Unchained is produced by Laura Shin with help from Juan Aranovich, Margaret Curia, and Pam Majumdar. Thanks for listening.